In my previous video, I shared my minimalism investment portfolio, which consists of only 3 ETFs, by which 2 of them are the well-known S&P 500 index funds or ETF, with SPY being my choice, as well as the Nasdaq 100 ETF, which is the QQQ. If you haven't watched that video, I highly suggest you watch that video after watching this video. I'll include a link in the description as well as in the YouTube card as well. Many people know that SPY or the other equivalent S&P 500 index ETFs and the QQQ are great investment, but somehow some people may have a few concerns. For example, some people might find the S&P 500 overly diversified as it consists of 500 companies, while some might demand an ETF or fund which is more diversified and they can just keep accumulating that single ETF, just like a supermarket of stocks. And if you remember, another criticism that these ETFs get are the heavy weightage towards the top companies, which is making it less than ideal from a diversification standpoint. And the concerns that people have just go on and on. Now, I couldn't list down every single concern that people are having with the SPY and QQQ, but I have prepared a handful of alternatives to both the S&P 500 Index ETF, SPY in this case, and QQQ, including alternatives that are priced lower than the SPY and QQQ as they are priced above $400 and $300 per unit respectively at the point of recording this video, and it might turn some people off from buying them. So let's get started. What is up everyone, this is Jin Hao. Thank you for tuning into this video and I wish you are doing well. Here in my channel, I share my personal opinions and experience on my journey in trading, investing, personal finance and things of that nature, just like this one. So if you're new here and you are interested in these topics, the subscribe button and the notification bell icon are what you need to hit. That does help me a lot as I'm in the progress of getting my very first 1,000 subscribers for this channel. And before we proceed further, as usual, disclaimer, I'm not a licensed financial advisor and I'm not licensed to give you any financial advice. Whatever I share in this video are solely based on my personal opinion and experience. Securities mentioned in this video are solely for educational purposes only and they are not buy or sell solicitations. So do your own due diligence and practice independent thinking when it comes to consuming this type of content on the internet. So now let's move on. In this video, I'll be suggesting 3 alternatives to SPY or basically any S&P 500 index ETF like the VOR and IVV. I'll just call it SPY from here onwards. So the first one would be an alternative to people who demand something more diversified than the SPY, and the second one would be an alternative to people who want something less diversified than the SPY but still get the exposure with the large cap companies in the US stock market. And more importantly, the top holdings are not as heavily weighted as the classic SPY. And also, the third one would be an ETF which also tracks the S&P 500 index but lower price. As for QQQ, I'll also be suggesting 3 alternatives to it. The first one would be an ETF which is exposed to the Nasdaq top 100 companies but in equal weightage. And the second ETF invests in the 101 to the 200 largest companies on the Nasdaq. Last but not least would be a lower priced version of QQQ which also tracks the Nasdaq 100 just like our QQQ but lower priced. Alright, so let's start with the first alternative to SPY. This ETF is for someone who wants something that is more diversified than the already very diversified S&P 500 ETFs. Now, there are a few reasons why people like this fund, including being able to expose to your money with more than 3,000 companies in just one single ETF, and yet the expense ratio is as low as 0.03%. And this fund is VTI, which is also the Vanguard Total Stock Market ETF. Investing in this fund is just like investing in the overall US stock market, and some people like this idea, although it is way too overly diversified, because it seems like a set and forget kind of investment strategy, and the only fund that they want to invest is this one. Although I personally prefer the SPY for this purpose, I have to say that the return of this fund is able to generate in the past has been very promising as well. One thing that I need to remind you is that the past performance cannot guarantee the future performance. But I personally think that as long as the stock market is going up, these funds particularly will be performing. Alright, so let's move on to the second alternative to SPY, which is an ETF that is less diversified than the SPY, but still get the exposure with the large cap companies in the US stock market. Now, this ETF is also issued by Vanguard, known as VTV or the Vanguard Value ETF. This ETF holds 334 stocks at the point of recording this video, with well-known companies like Berkshire Hathaway, JP Morgan, Johnson & Johnson, P&G, Bank of America, Intel, ExxonMobil, and so on being the top holdings. Now, despite holding less stocks than the SPY, the top holdings of these ETFs are not as heavily weighted as the classic SPY or any S&P 500 Index ETF, which might be a plus point for certain investors. The expense ratio is also class-leading at 0.04%, and the historical return has been great as well. At the point of recording, VTI is trading above $200 per unit, while VTV is trading at above $100 per unit, which are lower in price compared to the SPY and even VOO and IVV. Now, the next ETF to SPY is basically like a mini S&P 500 Index ETF. It tracks the S&P 500 index just like the SPY does, but it is priced at slightly under $50 per unit. Before I proceed, I want to explain why lower price does matter. Now, if you are watching this from countries like the US, whereby being able to invest in fractional shares and ETFs is a common thing, you probably do not get the idea why lower price ETF is a big deal for some people in other countries, because it is easy to just buy like 0.1 unit of an ETF based on your affordability. But that's not the case for the entire world. So for example, I'm from Malaysia, and it is relatively tough for us to open accounts with brokers that allow us to buy fractional shares or ETF. Yes, there are definitely a few brokers that we can open accounts with and buy fractional shares, but at the point of speaking, these brokers do not offer commission-free trading, and the worst thing is most of them are charging a maintenance fee for investors who do not maintain a certain amount of value in the portfolio. So this is definitely not a friendly choice for investors with small capital. But fortunately, there are some brokers that allow Malaysians and also other people from the foreign countries to open brokerage account with them and offer commission-free trading. For example, TD Ameritrade and First Trade. However, at this point of time, they do not offer fractional share trading just yet. Therefore, being able to invest similar thing at a lower price bracket is definitely going to help more individuals to get started in investing. Alright, so let's move on to our mini S&P 500 Index ETF alternative, which is SPLG, full name SPDR Portfolio S&P 500 ETF. At the point of recording, it is trading at slightly below $50 per unit, which is great for investors with low capital. Now, of course, the average trading volume is not as much as other mentioned ETFs, but liquidity is definitely not an issue here. This ETF basically operates just like any other popular S&P 500 Index ETF, and it is an S&P 500 Index ETF per se, just that it is not as popular as the SPY, VOO, and IVV. The expense ratio comes in at 0.03%, which is on par with VOO and IVV. Great thing. So if your capital is limited and your brokers do not allow you to buy fractional shares, considering this as an alternative. I call it a mini SPY or mini SPY. Alright, we have done with the alternative to SPY. Now let's discuss about the alternative to QQQ, which is the most popular technology fund that tracks the Nasdaq 100 index, or the top 100 companies in the Nasdaq, if you will. One major criticism about QQQ is the weightage of the top holdings. Apple and Microsoft alone weighs over 11 and 9% respectively. The weightage of these two companies is already more than 20% of the entire fund. Next to that is Amazon, comes in at over 8% weightage. From a diversification standpoint, some investors may not like this kind of weightage. So the first alternative to QQQ is an ETF which is exposed to the same 100 companies as QQQ but in equal weightage. This ETF is the First Trust Nasdaq 100 Equal Weight, code QQEW. Performance-wise, it is slightly below what the QQQ has done in the past, as the top holdings have been very performing all these whiles, giving QQQ an extra advantage here. And also, the expense ratio comes in at 0.58%, which is higher than a lot of technology or Nasdaq-related ETFs. However, I should say that the historical performance of QQEW is also very great. After all, not forgetting that this ETF is still investing in the top 100 companies in the Nasdaq. Price-wise, it is right now over $100 per unit, which is less than QQQ as well. So, if you dislike the weightage of the top holdings of QQQ, QQEW is an ETF that you can look into. Moving on to the second alternative to QQQ is for people who have slightly higher risk appetite, because this ETF invests in the second 100 stocks in the Nasdaq, which is the next 100 companies after the top 100. And this ETF is the Invesco Nasdaq Next Gen 100 ETF, code QQQJ. Just think like this is the junior version of the QQQ. Imagine the top 100 are the big brothers like Apple, Microsoft, Facebook, Amazon, and so on, while QQQJ invests in the next 100 companies down the ladder, which are companies that might have some rising stars, potential rising stars. Some of the companies invested by QQQJ are CrowdStrike, Roku, Garmin, Expedia, and the list goes on. These names shouldn't be too foreign to you if you have been investing or trading in the market. The price for this ETF is the lowest among these three, coming in at just above $30 per unit. But there's one thing to consider while investing in this ETF is whether you really want to invest in the potential growth on these second 100 companies in the Nasdaq market, or you just want to follow the market by investing in the top 100 companies. And now let's talk about the last ETF for this video, which is the mini Nasdaq 100 ETF, I would say. It is not as low price as the previous one, but this ETF basically operates just like the QQQ, but the price is about a third of the QQQ. And it is called the Invesco Nasdaq 100 ETF, or QQQM. This fund is a mini QQQ basically, and even the code is QQQM for mini, I guess. The performance and holdings are basically the same with the QQQ, just that it is priced lower. One thing worth mentioning is the expense ratio of this ETF coming in at only 0.15%, which is lower than QQQ itself, which has an expense ratio of 0.2%. So if you are looking for a lower price alternative to QQQ, there you go, your mini QQQ or QQQ mini. So that'll be all for this video. I hope you like this video, and if you find this video helpful, do not forget to smash the like button and share this video to people who may find it beneficial. And also, do not forget to subscribe to this channel for more future updates. Meanwhile, feel free to check out my other videos that you may find it helpful. Thank you for watching, and I'll see you soon. Stay safe and bye for now.